You've seen them everywhere, right? Circle K, holiday station stores, they're a global giant in the convenience and fuel game. But if you're an investor, Alimentation Couche-Tard is something else entirely. It's a company standing at a monumental crossroads, facing a massive shift in how we all get around. And the big question is, can they actually pull off the pivot? Their mission statement sounds pretty straightforward. But what business are they really in? It's so easy to just say, oh, they're a gas station. But if you think that, you're missing the entire story. Because where the real money is made, well, that's the key to understanding their whole future.
Okay, so check this out. This slide is basically the company's secret sauce. You see, fuel brings in almost 3/4 of all their revenue, a huge number. But, and this is the important part, it accounts for less than half of their actual gross profit. So where's the magic happening? It's inside the store. That second chart tells the whole story. Over half the profit, a full 52%, comes from the coffee, the snacks, all that stuff. The gas just gets you to pull over. The convenience store is the real profit engine.
So how in the world did they get this big? Well, that leads us right into the first pillar of the bull case for this company. They are an absolutely world-class mergers and acquisitions machine. And this isn't some happy accident. They didn't just stumble into being a global behemoth. Their growth is powered by a proven, repeatable, and incredibly disciplined process. They have a playbook for everything, finding companies, buying them for the right price, and then plugging them into their massive system to squeeze out every drop of value. It is a core part of who they are. And this tells you just how good they are. When Couche-Tard buys another business, they expect to create new value, what they call synergies, worth between 30 and 60% of that company's entire earnings from before the deal. I mean, think about that for a second. They're not just buying growth, they are literally manufacturing new profit by making these smaller players more efficient. For a shareholder, that is pure gold.
On top of that, they're just really, really smart with their money. They run what they call a capital allocation flywheel. When good acquisition deals are out there, boom, the cash goes to M&A. But if the market gets too hot and deals get expensive, no problem. They just pivot and use that cash to buy back their own stock. The key thing for you to know is that capital is never just sitting around. It's always being put to work to generate the best possible return.
But now we have to talk about the elephant in the room. The single biggest risk, the central conflict in this whole story, the global shift to electric vehicles. This is the challenge that could potentially undermine everything we've just discussed. And here it is, the threat and the opportunity, all on one slide. The old model? It's all about that quick 5-minute stop for a tank of low-margin gas. In and out. The new reality with EVs? The driver doesn't need fuel, and they're going to be hanging around for 25 minutes or more while their car charges. So yeah, this completely breaks the old business model. But at the same time, it creates this golden opportunity. You now have a captive audience for a much longer time, an audience you can sell a whole meal or a premium coffee to. And you got to give them credit. They aren't just sitting back and waiting for this to happen. Couche-Tard is actually using Europe, where EV adoption is much further ahead, as its own real-world laboratory. They're already running thousands of chargers, testing different strategies, and learning exactly what it takes to win over the EV driver. They're being proactive, not reactive. So how are they turning all these learnings into an actual strategy? Well, the company has picked off this really ambitious plan to fundamentally pivot the business, and they've given it a pretty bold name too. And this is the roadmap. They call it 10 for the win, and the goal is to hit $10 billion in earnings, or EBITDA, by 2028. Now, M&A is still the biggest piece of the puzzle, no surprise there, but look at the other parts. They're planning to get nearly $1 billion from organic growth, that's mostly food and loyalty, and another $1 billion from just getting more efficient. This shows it's not just about buying more stores, it's about making the ones they already own much, much better. And this stuff is already happening. Their Fresh Food Fast program is already in more than 5,800 locations. The big goal here is to make their North American stores look more like their super successful European ones, where food is a way bigger piece of the pie. We're talking about trying to double their food sales. And that Inner Circle loyalty program, it's all about using data to figure out what customers want and keep them coming back. So this all leads us to the most important question for any investor, right? What is all of this worth? Is the market giving them credit for this huge, ambitious transformation, or is there maybe an opportunity hiding here? Let's just zero in on one key number here, EV to EBITDA. It basically tells you how the market values a company's earnings power. Couche-Tard's trades at about 11 times its earnings. Now look over at their competitor, Casey's, the one famous for its pizza. The market loves that food-first business model and rewards it with a much higher valuation, over 18 times earnings.
This bar chart tells the whole story. The massive gap between Couche-Tard's valuation and Casey's, that's the entire investment debate in a single picture. The market is clearly nervous. It's giving Couche-Tard a discount because of the EV threat and the risk that this whole food pivot might not work. But, and this is the entire bull case, if they succeed and start to look more like Casey's, their stock could get a major re-rating to close that gap.
So let's just boil it all down. The bull case is pretty clear. You have a world-class operator, an M&A beast, they're smart with their money, and the stock is trading on the cheap compared to its food-focused peers. But the bear case is just as compelling. The EV transition is a real existential threat. Pivoting to fresh food is notoriously difficult to get right. And on top of all that, they're facing headwinds from declining cigarette sales. It's a real tug-of-war.
Which brings us to the final question you, as an investor, really have to answer for yourself. Is this an elite company with the skills and the plan to successfully navigate a once-in-a-generation industry shift? Or is it a giant, a very well-run giant, mind you, that's ultimately facing an unstoppable long-term decline? The answer to that will determine if today's stock price is a bargain or a trap.